Hello everyone and welcome back to the channel, guys. In this video I'm going to explain to you how to trade the PMCC. In other words, the poor man covered call. Okay, this strategy, it's well known for those people that doesn't want to buy shares upright, as you guys can see in this example here. Okay, for example, straight to the point, I'm going to explain a little bit briefly what the poor man covered call means in a second. But let's say, for example, the IWM, it is trading right now at 220.79. If you were to buy 100 shares of this thing here on a cash account, that's how much this will charge you, 22,079 cents. Why? Because you just multiplied that by 100. If you don't have that much money, of course not. Who's gonna spend all that money in buying shares and things like that? What we're gonna do is we're gonna buy a call option. In other words, a poor man covered call, very deep in the money, with a very high delta, like for example in this case 85 deltas, which I'm going to explain to you guys in a second. And we're going to buy one contract which gonna have us holding 100 shares of the IWM, and instead of spending 22,000 plus, we are going to have a maximum loss of $8,031. Okay, this is the maximum loss, because if you do have portfolio margin on your trading account, you might be able to, let's say, have way less margin requirement than this. Okay, but another thing I want to show you guys, like here for example, you must know where to pick your strike price, because in this case here, if we were to sell, let's say in this example I'm going to show it to you in a second, TastyWorks platform, if we were to sell this strike price here with these days to expiration, with this DTE, which is like a days to expiration of 24 days, guess what? You're going to lose money if the stock price go past our strike price. Okay, why? Because this is not enough money for us to collecting to pay for the cost of the long call option. So you must know where to place your strike price. Okay, very crucial that you do understand. So anyway, for those of you that follow my channel for a little while, guys, don't forget, click on the first link below and you can pretty much download for free a lot of the strategies that we use in this channel to make money on a daily basis. It's free, by the way. You just need to click and collect your free guide, not just for the poor man's covered call, but of course covered triangle, cash secure put, all those good stuff that help us to make money on a weekly basis. Okay, so basically very simple, like I was saying to you guys, we're gonna use here the ticker symbol IWM, which pretty much the ETF that tracks the Russell 2000. Okay, so in this example here, as I show you guys in the Excel, we are going to buy a long date options, in this case here at 843 DTE, which it is 15 of January 2027. And we're gonna buy a dip in the money here with the delta of 85. Okay, this is your delta. You must know where to pick your deltas, because the reason why we're buying the deltas all the way up down here, guys, because the theta decay in this case here, okay, will be very slow. You don't want to buy your long call option, in other words your lips, okay, with the delta of 70 or 60 or 50, because the time decay will pretty much kills you. Okay, that will kill you. So we're gonna buy here a 150 strike price, as you guys can see here, with 843 days to expire, but we're going to buy this delta here of 85. Okay, very crucial. And of course, to buy this option here, we are going to pay $84, and this is just for one contract. Don't forget that. Okay, very crucial that you guys do understand. And in this case here, we are going to pay $8,400 with a maximum loss of $8,400. So we can do this thing in all in one go. We can go and pick our short term now. What I'm gonna do is I'm gonna come all the way down here, and we're going to collect on a 24 days. Okay, I'm gonna show you guys the wrong way to pick, which you're gonna lose money. We're gonna pick here, let's say for example 228 days. Okay, we're gonna sell here our first slip with 224 days to expire on 18th of October, one single contract. Because remember, we bought a long call, one contract. We're gonna short one short call, also one contract. Okay, we're gonna collect $1.75 for that. Great. So what we're gonna do is, if I go back here to the Excel, I'm gonna show it to you guys in a second. exactly like we did. Okay, today we buy the long call option at $150 strike price. We paid $81.50 for that long call option. It has a delta of 85 and has a DTE of 843. The same day today, we sold a call option of 228. We collect 177, which it is here, as you guys can see. Let me see if I can go back here. This 177 here, okay? Just keep that in mind. And then expire on 18th of October 2024, which it is a delta of 30, okay? And as you guys can note, I don't know if you pay attention to that, our delta here, it's 30. Okay, but the thing is, if I go here on the curve, actually if I put back here the 150 now, okay, if I put the 150 now, and if I go here, for example, okay, imagine if the stock goes up to 228. As you guys can see, to 228, we have a loss of $173 because we just not collect enough money to pay for the price of the long option. Of course, this expiration, okay, because theoretically speaking, we'll be making 1,068, but this is the expiration date. That's what I'm taking into consideration. If I go back here to the Excel, and this is exactly what we have here, guys, okay, let me make a zoom here. This is 1,069 minus 173. If I put this thing here to the side, this, as you guys can see on the Excel here, we're gonna lose 173, exactly like TastyWorks is showing, okay? And this will be, of course, a minus 2.17 return on our maximal loss of 7,973, if of course the stock goes to zero. But now we're gonna change our strategy a little bit. What we're gonna do is we are going to sell a different strike price. We're going to sell a strike price of 233, but this time we're going to increase our DTE a little bit. Okay, that's the goal of our strategy. So if I go back here, what we're going to do is we, instead of selling here, for example, this, let me go back here, delete this 24, we're going to go up to 25th of October, which it is this one here with the strike price of 233, which it is at this level here. Okay, so at 233, now things change a little bit. As you guys can see, if the stock goes all the way up in 31 days, which it is the expiration of this short call option here, if you go up to 233, as you guys can see, we are going to have 233, we're going to have a profit of 269, as TastyWorks is showing at the expiration date, okay? So basically, if I go back here, this is exactly what we have here, okay? As you guys can see, if the stock goes to 233 at the expiration date, we're going to make $269, okay? And this is exactly what we have here in our spreadsheet with our formulas, okay? Our maximum loss, of course, is going to be 8,031 if the stock goes to zero. But in this case here, because this is our maximum loss, that's the money we have to pretty much put up front to fork this long option here. If we collect this every 31 days, okay, what we're going to do is you're going to make 3.35% return every 30 days. Annualized is going to give us roughly 40%. Okay, this is amazing, 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 amazing. But of course, are we going to be able to continue repeating this strategy every 30 days? Probably not. But if we do, annualized, we go from 3.35 in 30 days, basically a month, to 39.4 annualized. And of course, if we were to buy the stocks, will cost you $22,000. If the stock goes up to 233, it's gonna be worth $23,300. You're gonna make $1,221, which will give you 5% on your initial capital invest. And annualized will give you 65%. But how often you see a stock price go up? 5% in 30 days, 5%. 5%. This can be happening, of course, Tesla, all that kind of thing, but this is not what I'm talking about. These guys is to make money consistent. It doesn't matter if the market goes up, go down, goes up, go down. Is to make money consistently. That's the main thing, okay? Another thing to pay attention here, for us to make here this 5.53%, we have to fork here almost 18% of our initial requirement of in terms of buying power, which was the $22,000 out of $125,000 account. But here, the $8,000, which is the maximum loss of our poor man's covered call, it's only cost us 6% of our initial capital here of our account balance of $125,000. That's what I'm talking about. This is the main thing, okay? Because our goal, it is to get roughly 12% per year. Okay, because if we get 12% per year, which is roughly 1% per month, if we do this thing here, we can get way more than that. Okay, we don't need to get, let's say, 3.35 in 30 days. We can get way less, because here, for example, if we get here, let's say, $85, as you guys can see, look at this. Sorry, let me go back here 1 second. As you guys can see, we got here. 1 second, guys. Okay, let me see. As you guys can see, we got pretty much 1% every 30 days, which it is our 12%. Okay, so what I'm trying to say here is, instead of getting this, let's say, let me go $269. Okay, what we can do is we can go back here to our TastyWorks, and we can pretty much get this call here all the way up here. Okay, all the way up here, which make us even more. Okay, even more. So basically, we can pretty much decrease our risk in terms of making less money and give you more space here for the stock to rise if you were to rise. We're gonna make less here in terms of premium on this call option because we are away from the current market price. But if the stock rise, stock will have a great distance to make money in terms of capital gains. Okay, and we can repeat this thing here every single week or every single month if we want to. Okay, so the main thing here, you must pick up the right strike price so you don't lock in a loss. If the shares goes up every 30 days or 7 days, whatever how many DTE you have for your short call option, making the leap, okay, or the covered call, Pullman covers call, you need to make sure that if you have your strike price all the way down here, like we had here in this example at 150, and if we paid here, let's say $80, so our break even, let's say it's 130, you need to make sure you sell here your call option here, let's call number one, enough above our break even of our long call, so you don't lock in a loss. Because if this thing here shoots the moon, you got a call option here, you can lose money instead of making money. So you need to have those calculations right to make sure that you're collecting a positive premium in terms of your covered call on your leap strategy using the Pullman covered call. Okay, that's the main thing. Sell your call option. Buy your long call option with a delta of at least 85. That's the main thing. Okay. Also, in terms of DTE, at least 2 years, we are way above 2 years here. So we are okay here, we are okay here. That's the two main things when it comes to your long call for the Pullman covered call. First thing you're gonna do is delta above 80, 85. And in terms of DTE, at least 2 years. And then you're gonna do is you're gonna pick your strike price that you don't lock in a loss. That's the main thing, okay? In terms of deltas of your short call, what you're gonna do is, in this case here, I have a 20 deltas, but actually, if you go back here, for example, okay, TastyWorks, if you go back here to table, the call option we're selling here on 20 on 34, and the call option was 233. So the delta was 20, so that's okay. The delta is right here, okay? The delta, it is 20. So in this case here is a 20 delta, but it's whatever delta give you a positive premium so you don't lock in a loss. That's the main thing when it comes to picking your strike price for your covered call, okay? In terms of the Pullman covered call, very, very crucial that you do understand, because if you lock in a loss, you can lose money on a strategy that is very simple to make money. When I mean simple, I mean, guys, in terms of trade management, that's what I mean simple. There's no secret here. The main thing, it is not locked in a loss here in terms of your premium. Make sure you got a premium here, positively, of course, and you got your deltas here of your long call at least 80 plus, and of course your DTE at least 2 years plus. That's the main thing when it comes to the poor man covered call to make money. Otherwise, you will lose money. So keep attention to these 3 details, which are very, very simple. And of course, to finish it off, guys, your position size, like I always talk about in this channel, and of course, what type of security you're going to trade. In this case here, I'm using IWM, but you can use here, okay, triple Qs. You can use here SPY. If I was you, I would stick with the ETFs. Okay, especially for those of you that are beginners when it comes to trading options. Stick with ETFs. Once you know all this in and out, guess what? You can adventure yourself on Tesla, Nvidia, Amazon, Meta, what else, guys? All those good stuff. JP Morgan, all those good stocks. But if you do this thing here on penny stocks, GMC, AMC, like gambling stocks, like YOLO stocks, you're going to lose money. Okay, it doesn't make sense. Of course, you're gonna collect way more premium. Even trading Tesla here, for example, these will be greater, guys, than this on Tesla. But again, it's a stock. It can go down way more than can an ETF. And an ETF probably recover. Can a stock recover? Sometimes it doesn't. You get the point. Anyway, hope this video has added some value to you guys. If you like the video, leave your comments below. If you have any question, also leave your comments below, and I'll answer to all of you as soon as possible, okay? Thank you very much for watching. All the best, stay safe, and happy investing.